I'm joined today by Will Herrmann from West 11. Welcome, Will. How are you?
Very good, thank you. Good to be here, Matt.
Thanks for joining us. For the record, I'm at home in Wimbledon. This is one of Will's developments, which was around the corner from me in Wimbledon. You're not actually in Wimbledon today, though, are you, Will? Where are you today?
I'm down in Cornwall, where we live. We decided to exit London at the beginning of last year, which was quite a wise move before lockdown. So we spent our time down here, but we've got our projects split between London and Cornwall.
So, that's quite an interesting way to set up your business, isn't it? You've got, because London's one market and then the Cornwall's a very different market. Tell everybody who's listening about the types of deals that you do.
Well, the bit of Cornwall we're in is pretty like the London market. Cornwall's definitely a 2-speed economy, and there's a 5-mile ribbon around the coast that looks pretty close to Chelsea or Fulham. And then a little bit more inland that's quite a lot different to that. We build speculative residential developments for typically GDVs between 10 and 20 million pounds. Our sweet spot is probably 12 to 15 million. We try and build developments that people want to live in. I guess that's our focus.
Quality.
We are not driven by pound per square foot and yields on the basis of what can you pile in and squeeze in. We try and build real homes with space, with good storage, places where people make an emotional connection, want to buy it. And that's how we try and set ourselves apart in the market.
Now, the interesting thing about you, Will, because we've known each other a little while, was, and I think this is worth mentioning, you got started in property by underwriting at auctions. And when you were underwriting at auctions, tell everybody how many deals you did.
I got started in property first when I was at university, back in the wonder days, and I didn't want to pay rent. So I bought 5 bed sets, converted them into a student house and lived for free for 2 years. Back in the wonder days where I had a handwritten business proposal on 2 sides of A4, and I borrowed 105% of the cost in Barclays Bank on White Ladies Road in Bristol.
Topped up with a student loan as well, I'm sure.
When I started out doing it properly, I didn't really have any cash. I had a little bit, but not a lot, and I needed to boost my cash reserve. So I started out by underwriting and auctions. So I would find a lot I liked. I would have a price that I was prepared to pay for it, and I'd approach the seller and I'd guarantee them a minimum price.
How many deals did you do?
4 or 5, but
Did you actually buy anything? I thought you were underwriting everything, but you never actually had to come through.
I never bought anything.
There you go. Making money in property without even buying anything.
And I split the upside above my minimum value and what they got with the vendor 50-50. And I did that a few times, and that helped me boost my cash reserves and then get into developing. Good
stuff. Now, I first came across you because I knew the investor that backed your Clapham deal, the bakery. That was a office to resi, or PD, was bakery to resi, I believe.
Yeah.
When was that? Was that in 2013? Was that right at the beginning of the PD rights?
We bought it in later, end of 2014. And we bought it off Nick de Savary, who had bought it himself as a planning play to convert from office to resi. And he bought it and then got the gift from the gods that was PD. And so sold it on to me without doing anything.
Fair play. And Cornwall, where you are, am I right in thinking that's 140 acres with planning for 11 houses?
Yeah, it's a 140 acre farm. It's got a semi-derelict 16th and 17th century farmstead in the middle of it. We bought it at the end of 2018. Between exchange and completion, we got planning permission for 11 houses using the existing buildings on the farm. That gave us the value that we needed to underwrite it. We bought it with minimal cash. We managed to buy it with debt because of the value uplift we got from the purchase price to the actual value. And now we've thrown that planning out the window. And we've got an application in for a 60-key boutique hotel, spa, 2 restaurants, leisure facilities.
So like a Soho farmhouse in Cornwall.
Like a Soho farmhouse in Cornwall, maybe a little bit less shiny than Soho farmhouse and a little bit more facility than the Pig, I guess, is where we're pitching it.
Yeah, shiny, but not like really, really, really shiny. But
Yeah,
your
yeah.
finishes are normally pretty good. This is a typical finish for you, very tasteful. This deal kind of annoyed me a little bit because this is at the end of my road in Wimbledon, and you bought it off market, got planning for 6 apartments and 3 Muse houses along the side there. You also had a bit of a shocker recently with one in Battersea, which you're not afraid to mention.
No, we've got a development in Battersea that is been pretty tricky. And we took the decision at the sort of second half of last year with the bank that we'd put it into administration. We needed to give ourselves time. We needed to protect ourselves from some of the smaller creditors because they can do a pretty good job of derailing something more substantial for the people who've got serious money invested in something. So we took the decision with them to put it into administration. We've been working through the process, reimagined the scheme. We've got a reasonable claim against one of our cost consultants that we're holding in the background. But having said that, we're reinvesting. I hope we're on the verge of taking it out of administration and we'll be able to develop it out and it'll be a success story too. But
yeah, good luck with that, Will, because I hope you managed to rescue that one in some way, shape or form. Hasn't stopped you doing deals either. You just picked up a Muse House development in prime central London as well. I'm not going to say too much about that because I'm not sure you've secured it yet.
We're not exchanged yet, so that's enough said, I think.
Yeah, keep that. Mum's the word. Right, let's get into the content today. Will, if you hear me come out with anything you disagree with, by all means challenge me, correct me, but hopefully that won't happen too often. Hopefully we'll be working together. Hi, I hope you're enjoying the free content. My name is Matt Siddell. I started Qandor in 2017. In 2020 we launched a property academy called Tropolis. If you want to know how you can come and join our fantastic network and work with the wonderful people that we help and support, then click the link below and book your call with me today. Most of you will be familiar with Qandor and Tropolis. Qandor is the club that I started in 2017. It's for investors, developers and business owners who are already doing deals above £1 million. And Tropolis is our property academy that we started last year. Today, we're talking about how to get your investors into deals successfully. I'm going to start with the basics because where I want to get to, I can't get there without covering the basics first. So if at the beginning you think I'm teaching you to suck eggs a little bit, bear with me because I will move at a decent pace. We'll take questions from the audience and I'll get Will to contribute as well. And by the end of it, I've got a couple of really good tricks to share with you. I've never seen anybody else talk about this stuff in webinars or networking events or what have you, certainly not on the main circuit. So stay tuned and make sure you're here to the end because I've got a really good trick which I want to share with you. So covering off the top 5 ways to buy sites, first of all, because inevitably, if you're going to be working with an investor, this is the point where the investor's cash is going to have to come in. The investor's cash goes in first, out last, because the bank goes in last and out first to make sure that they don't lose any money. But the top 5 ways, we won't spend much time on this. You can buy cash, you can buy unconditional with debt, or you could use a land loan. That is quite risky because you've got a refinance risk once you get your planning through. You can do a conditional contract, which could either be an option agreement, a subject to planning, or you could do an exchange with a delayed completion, which one of the Tropolis members recently did very successfully in Reading. Thought they were going to walk away from the deal, and actually, because the deal was unmortgageable, and I told them, no, this is perfect. You're going to exchange, give yourself time to do the refurbishment, and then you're going to complete the transaction 9 months later. The other way you could complete is with development finance. If the deal's already got its planning, that's quite good because you don't have any refinance risk. But lenders can get into trouble as well, so it's not without its challenges. And then if the asset you're buying is producing some income, you can just get some regular kind of term finance to fund the purchase of that property. So covering the basics off first of all before we get into the meat and vegetables of today. When it comes to finding investors, the number one place you're going to want to look is going to be friends and family. And the reason you're going to want to start with friends and family is because those relationships and those connections are warm. The second place you might want to be looking will be friends of friends, because those are warm introductions. And actually, that's how I met my JV partner for the portfolio that I built in Reading in 2012 and 13. He was a friend of a friend. Someone gave me a good character reference, and we built rapport, and we did the deal together. Interestingly, I was thinking about this morning. The way I structured that joint venture with that investor would not be like that if I did that deal today, because for anyone who's been smart and gone through my company's house record, you'll see that he was a director of several companies for a very well-known institution that manages multi-trillions. And if you then Googled him, you'll see that he was managing $1.8 trillion when he retired a couple of years ago. So the last thing he needed was more income. And I should have structured the deal with him so that he got more of the capital appreciation and I took more of the income, because that would have been a win-win. But I didn't know then what I knew now. And even though we had an LLP where you can split the income and you can split the capital gains, we went 50-50 on the lot. So he was paying all this income tax and I was trying to build up my income. I could have just done it much more quickly if I'd said, you take the lion's share of the capital appreciation, I'll take the lion's share of the income, and we'll both be better off. After you've tried the friends of friends, you should try property people, because they get it. They understand the deals, and you've got a better chance of getting them across the line. Other places you can look for investors would include joining a network that's got a similar set of values to you. So if there's one that you're particularly drawn to, whether it was Qandor or Tropolis or ABC network, then get in there, get meeting people, and build up your reputation positively, hopefully, and find people to do deals with. You want to be thinking about raising your profile. You want to be thinking about leveraging your social media channels, because that's a great way to connect with more people so they can track you and follow your progress and engage with you so easily these days. 5 or 6 years ago, when I started posting about the deals that I was doing, there were people that I hadn't spoken to for maybe 10 years who'd been busy running a business for the last 10 years, and they had cash and they wanted to do deals. So do think about consistently using your social media. The trouble is, when you get really, really busy, you don't have the time to do that, but you can get other people to help you and do it for you. Brokers are always connected to capital and not just debt. So if you work with the right brokers, they'll make good introductions. And if you are struggling to find the investment, then you could always go to someone who's experienced and tap into their network by giving them a stake in your deal. So, I mean, Will, you've pretty much, do you spend most of your time looking for deals or looking for money?
It used to be a juggling act of both. Now I probably spend more time looking for money than I do looking for deals, because I've got people who help look for deals for me. We're a little team these days. But I think you're right. Money is about making connections with people and understanding who you want to take cash from. And I think it's important. One often thinks when you're going out to find cash that it's all about them examining you, because they're giving you the money, whether that's lending or equity. But I think it's just as important for you to do your due diligence on who you're taking money from, or probably very importantly, who's promising that they're going to give you money. Because there's a lot of people out there who will walk it right up to the line and then say, I'm really sorry, but I haven't got the funds, or make an excuse because I haven't got the funds, and you're left holding the baby. So establishing an understanding with the people that you're going to work with pretty early on and doing your homework on them just as they do their homework on you is very important, I think. Probably some of my earliest worst lessons were taking it for granted that the people I was going to do deals with or take money from, A, had the money they said they had, but B, were the sort of people that you wanted to take money from in the first place.
Bet you got some stories which we'll have to go into.
There's some stories that are certainly not for this forum either. You know them, Matt. At least stay in the pub.
Yeah. So, but you made a good point there, and it's my next slide. How to approach an investor. You are not begging for money. You should be offering them a funding opportunity and a handsome return. And I think it's worth bearing that in mind. So, tips for investors: they must be motivated. You do want to assess their risk profile. Is Mr. or Mrs. Investor in a wealth building mode where they might want to take a bit more risk, or are they in a wealth preservation mode where they might want to take less risk? And you can, just because they've got one risk profile or another doesn't mean you can't work with them. It just means you must work with them in the correct way. They must have money and time for your deal. Everybody's short on time these days. We all find things to keep us nice and busy. And if you've got a great opportunity and you take it to someone, they've got no time to look at it, you're not going to have much chance of getting that deal across the line. You want to be avoiding the tire kickers. And when you do start conversations with people and you want to take the deal forward, you need to be using the next step strategy so that at the end of every call or every meeting, you've already agreed what the next step is and when that will happen, and you put it in the diary. And the person who taught me that is Mrs. S. She works. This is how she. This is her career. This is how she makes her money, raising money for an American firm, and she lives and dies by the next step strategy. No one gets out of the room. No one gets off the phone until the next step has been agreed. But most importantly, you need to be building rapport. The reason you need to be building rapport is because of the amygdala. I think there's actually two of these. They're about the size of an almond, and the amygdala will. It's the part of the brain that gives the fight or flight mode reaction to certain things. And if you haven't built rapport, this amygdala is going to be sending off the fight or flight and getting in the way of you doing deals with your investors. But just bear in mind that building rapport is not just it's a biochemical process, and you're not going to do any deals with any investors until you've built some rapport and you feel like you understand each other, and that all takes part in the amygdala. Will, how many times do you reckon you need to meet with an investor before you and the investor is comfortable enough to really talk serious terms?
I think it depends what the offer is, doesn't it? So we raise money sometimes where we might have lots and lots of little lots that we sell, and in which case, if the ticket size is 20 to 50,000 pounds on a £1.5 million raise, then we might do it on a single phone call. If we're looking for more significant amounts of money, and my experience is always that those investors are the ones that are more useful in the long run, then it takes some work, and it is, they'll do a lot more work up front before they pass their money across to you. But once they've done it, they're much more sensible and easy to deal with. I always think that, the amount of time you need to spend with an investor after they've invested is kind of inversely proportional to the amount of money they've put in. But the amount of effort you have to put in up front is probably the other way around. So, I guess with, initial meetings, breakfasts, having a beer in the pub where half of it you're talking about the rugby or something is just as important as anything else in establishing that there's enough there that person is happy to give you their money and leave it with you and trust you to deliver on what you say you're going to do, but probably more importantly, keep them informed and tell you what you're doing if it's not going as well as it should do.
This leads in quite nicely to a question that's just come through. It's from Andrew Ellis. He says, I'm looking for 5 million to part finance a 127-acre site with planning for up to 100 luxury lodges. What type of investors should I be looking for? And Andrew, I think you sent me this on email a couple of weeks ago, and I had a quick look at this, and I know one of the people behind this he's a board director at Savills, because he bought 2 houses off me in Reading by coincidence. That's quite amusing that this is the first question that comes through. But when you're trying to raise 5 million to part finance a 127-acre site with planning for up to 100 luxury lodges, there's so many ways to skin a cat, isn't that right, Will? You could go down the fund route, or you could go down the bonds route, or you could go down the equity investor route.
So, where do we start with that question, I suppose? What's your site value right now? What do you hope the site value will be with planning? Have you got any skin in the game? What equity is already there? Are you looking to fund, straight up equity at the beginning, or is there some in and you're looking for some debt? I guess, where do you start in the answer to that question?
No, there's certainly a lot to consider. All right, let's keep moving forward because we've got plenty of slides to get through. So we covered off the risk profiles. I've got investors that I've worked with in the past, and they want to take risk. They're trying to accumulate wealth. They want equity, or they want higher returns, and they will manage their risk. But they're generally professional risk takers. That's how they've made their money as investors. But then at the same time, I know other people who really don't want the stress of taking risk, and they'll happily lend, but they want to take the position of the bank and have first charge. And maybe they'll lend you more than the bank would lend, but they want that first charge position so that they're not exposing their risk. Let's have a think about how to structure the returns with the investor. Let me just close a couple of windows here. So this is right at the basics, and we're going to get more technical as we move forward. But fundamentally, you've got the fixed returns, and then you've got the profit share. And the fixed returns are really very easy. Straight loans. The cheapest way to get a fixed rate loan from someone is to bring them onto your deal in an earn as you learn capacity. I've seen people borrow at very cheap rates, offering this earn as you learn. If you haven't got anyone that wants to do an earn and learn, whatever they call it, then you can offer them first charge security. Chances are you've probably already given that to the bank though. But if you've got a private investor and they've got cash, it's so much easier to do deals cash than it is to have to deal with the bank's admin and their processes and their policies. When my JV partner and I went out and built the portfolio in Reading, and in fact this house and his house in Primrose Hill, we were doing a lot of that cash, and it was just much easier. Do the deals cash, go to the bank and release some equity, and then go again. That's obviously quite a privileged position to be in. But if you have got a private investor, there's a dentist actually who lives around the corner from me here, and he lends out first charge, but he'll do stretch senior. So he'll give you nearly all the cash, provided he can have first charge. And it means that you're dealing with someone who's very quick rather than a bank that is typically not as quick as someone like a private investor would be. Commonly though, as developers, it's highly likely that we've given the first charge away to some lender, and an investor's going to come in with a second charge, which is what we call mezzanine finance, and that's pretty much a snapshot of all the fixed rate loans. For the high net worth and the sophisticated investors, you can go down the variable returns route, and this is where today's presentation is going to become a bit more sophisticated. And then hopefully by the end of the presentation, you'll have a better understanding of how you can piece all these together to get your deal funded and not necessarily give away all your profits, because that's the last thing you want to do. But if you are approaching people for a fixed rate loan, I knocked up this very simple table, which shows you how you might persuade them. And this presentation is going to be recorded, so you can go back and capture this and put it into your presentation if you want. If they have £100,000 and they leave it in the bank as cash, inflation is going to erode it by 2% per annum, approximately. That means their gain is going to be down 2% per annum, and their £100,000 cash at the end of a year is going to be worth £98,000. If they were to lend to you at 10%, sure, they're going to have to pay some income tax on it, but they'll still have some cash left over at the end. Inflation is still a factor, so their 100 grand in real terms will also be subject to the same inflation as if they left it in the bank as cash. But the point I'm trying to arrive at is that it's the difference between being up 6%, it's the difference between being up 4% or down 2% that you must focus their mind on, because there is no middle option here. They're either going to leave it in cash, in which case it's going to go down by 2%, or they can lend it out and pay their tax and be up in real terms 6%. And for a basic rate taxpayer, perhaps if the loan was in the name of a partner, the difference becomes 8%. And interestingly enough, at least for until the budget next week, corporation tax is 19% at the moment. I'm betting it's going to be at least 23 to 25% by the time the budget's done next week. But if you were to put your loan through a company, a limited company, then you can shelter under corporation tax and not be subject to the higher rate tax that higher rate taxpayers have to pay. So inflation is a big driver for people to lend on fixed returns. And if you're sitting on cash, your cash is being eroded by inflation. That was the whole reason the investor bought houses with me in Reading in 2012. And it was the reason we bought them cash. He had a lot of cash, and he knew that if we tried to inflate our way out of the challenges of the credit crunch, his cash in real terms was not going to be worth as much. And he just went buying property. He bought a house for his sister, he bought a house for his brother, he bought a house for his dad, he bought a load of houses in Reading with me. We built the portfolio, and it was all because of inflation. But specifically, he was worried about hyperinflation, which didn't materialize. But that could be a threat as we come out of this pandemic that we've all been dealing with over the last 12 months. So a few pointers to think about on the fixed returns. As a borrower, as a developer, you always want to roll up the interest. Bit silly servicing the debt if you've got to pay the interest as you go along. The deals the lenders are going to be wanting to back the deal with a first charge or a second charge if they know what they're doing. The lender should back the deal, do not back the business. Those were the exact words of Mike Ingle when he spoke at my event in Knightsbridge in 2016. And what he was trying to say was, don't go down the mini bonds route because they tend to turn out to be a house of cards. Some of them are Ponzi's from the beginning, and some of them accidentally ends up as Ponzi's. But he was saying, don't back the business, back the deal. You want a first or second charge on the property. So this is quite important. I don't want to go into too much of a rant, but over the years, I have seen lots of developers start out doing personal guarantees and doing the mini bonds and doing the loans and the corporate loans and the unsecured loans, and it quite often ends up as a big pile of poo. We've spoken about the mini bonds before, Will, haven't we? Because I know that they piqued your interest. I don't think you were particularly impressed with them either, were you?
I just don't see what you're investing in. I think that's the issue. You're putting your money into hot air and hoping someone doesn't screw it up. And I think if you're trying to attract investment, or if you're looking at investment, you want to know what your investment's secured against. And so either it's a first charge or it's a second charge, or you should be having capital in the vehicle that owns the property, if that's the way it's structured. But you want something tangible so that if it crashes, there is a route to some sort of recovery.
Yeah.
And I think if you're trying to get somebody to come in and invest with you, you should be thinking exactly the same way as how you would want to invest. And
yeah. This came up a couple of weeks ago. One of the Tropolis members works for Apple. He's an architect. He's based down in Hong Kong, actually. And he wanted to invest in a deal. And we started talking about security, and there wasn't a great deal of security in the loan that he was considering. And the topic of the mini bonds came up. I did this on a spreadsheet in front of everybody. The thing with these mini bonds is that the brokers are receiving about 20% commission. So if they raise £1 million, they take 200 grand, and then they go on holiday to Dubai or Vegas, wherever they like to go. But the developer's only got 800 grand. And in 12 months' time, he's going to owe the £1 million plus the 10% interest. He's going to owe 1.1, and it's too much. By the time that, but the other thing that's really worrying about it is they have discretion over those funds, so they can use them for all sorts of really fun things that don't necessarily give the investor much chance of getting their money back. But let's not spend too much time talking about that shit. Let's get on to some proper content. Second charges. So, few points to mention about the second charges. The first charge lender must agree to the second charge. The first charge lender is required to sign an intercreditor deed. You cannot switch the second charge lenders without consent from the first charge holder. There's a little trick that you could use. You can use an SPV for the second charge lenders and give them shares in the SPV, because then you can switch out the shareholders in the limited company that holds that second charge. If the individuals are holding the second charges, you're going to have a hard time switching them out, because the intercreditor deed is going to prevent you from doing that, because in the instance that the deal got into hot water, the first charge lender doesn't want anybody who's standing in the way of them and potentially getting hurt being switched around or anything like that. But you can, and I've seen people do this, use limited companies, and you switch out the shares in the limited company to switch around the second charge lenders. But just bear in mind, you can't switch a second charge lender without a first charge lender's consent. And if your lender is kind enough to accommodate a second charge, or organized enough to do that, what you'll probably find is they'll say, yeah, we're okay to do a second charge, but you use our intercreditor deed, we're not changing a single letter, and it's that, you can take it or leave it. But bear in mind that if you are working with a lender and you do intend to get a second charge into your deal, you probably want to be asking the broker or the lender upfront in writing on email, declare it, say, I have an investor, they want second charge, they won't sign a PG. Please confirm that I'm not going to be asked for my investor to sign a PG in the 11th hour, and that you will accommodate a second charge and not fob me off with an RX1 or restriction on the title deed. Will, have you ever had any hairy moments in the 11th hour trying to get an investor into a second charge position? And
so many, more than once. But I was going to say that
bloody annoying, isn't it?
There's second charges. You always have to think as well that it's a really strong effect on the time. The hardest thing, whether you are using an investor at a second charge or a real estate fund or something like that that's providing that money, the intercreditor deed causes all the trouble in the world.
Why do they always try and close the deals on a Friday, and then one of the solicitors is off work anyway, and then
Christmas Eve? The number of deals that end up closing at Christmas Eve, and you're pulling lawyers out of their lunches. But you think you can do everything in a time, and everybody will tell you everything can be done in a time scale. And the thing that will always balls it up is the intercreditor deed. And there'll be a big standoff between everybody, and then in the end, the senior lender always gets his way. But it's always the same. And as for structuring things using SPVs, that's our typical structure is to do that. So we have a holding co and a development co, and the development co owns the asset and the holding co owns the development co. And the reason we do that is so that we can bring investors in and out. We can repay people if they need to be repaid. We can give a share charge over the holding company to the bank as part of the finance, and none of it in fact affects our investor. They can come in, they can have the security they need, but they can be unbothered by the day-to-day running of it, because the majority of people that we work with, once they've put their money in, they want to be left to get on with it.
Yeah, you've got holidays in the Maldives to deal with and that sort of stuff.
Yachts to float around.
All right, so look, last couple of slides on the fixed returns, then we get into the more exciting part.
Before we get there, we just had a question from Victor Lai, who said, how enforceable is an RX1?
I've never had to enforce one, I've never had to deal with one, but they don't have the same value as a second charge. And I did see a case last year where one of the investors in the club was wanting to do a deal, and they were told they were going to get second charge, and the bridging company turned around and said, "I'm sorry, we don't do second charges, you can have an RX1." And it did stop the deal from going ahead because the investor wanted that second charge. Have you got much experience with RX1s?
I've given them and I've had them on other things. I found that restrictions on the title are really useful if you want to take options, or if you're giving a non-tangible security to somebody. We've had some fairly complicated deals where there are other stakeholders who will be getting things maybe out of a planning gain or something later. And by having a sort of documented restriction on title, I think they work quite well then, because it means you have to get the consent of everybody to do things unless the senior debt is enforcing. But I think as a means of securing investment, they're not really great. No,
I think the lenders and the investors in the sharp suits don't particularly like RX1s, but between friends and family, to give you a bit of comfort, it could help get the deal over the line. But second charge is better. And there are some investors and lenders in sharp suits, they wouldn't even like a second charge, but there are some who specifically that's what they do. And we've got second charge lenders in our network that we send business to, and some are better than others. The ones who really know what they're doing, they'll look at your deal, they'll look at your appraisal, they'll look at their position and be like, yeah, fine, there's the 200 grand second charge. Here's my solicitor's details, and you get it done. We're going to have to keep shifting to get through everything. So quick note on fixed returns. Obviously, you can't give a charge if you don't own the asset. So if you're taking planning risk and doing things like that, first charge and second charge, unless you own the property or you own the land, isn't going to be much use to your deal. So just bear that in mind as well. You're going to need some other security. In terms of the legals for the fixed returns, simple loan agreement, the borrower or the deal should always pay for the loan agreement. If you go to the bank and you ask to take out a loan, they will charge you for their legal costs, and it should be the same if you're borrowing from a friend or family member or someone you've met through a network. The borrower should always pay, and the borrower should be paying for the lender to have independent advice from their own solicitor. If someone puts a pretty skinny looking one-page loan agreement in front of you and says it's been drafted by McFarlane's, chances are it's not been drafted by McFarlane's, and you just say, I would like my lawyer to check this. His fixed fee is somewhere between 700 quid and 1200 quid. And I won't borrow unless he's looked at it. There's lots Loan agreements are simple, but there's a few simple things that need to be in there. The most simplest thing that needs to be in there is a repayment date. I did hear of people making loans to someone, or someone taking out loans, and everyone was signing his loan agreement, and it had no repayment date. And if anybody wants to give a loan with no repayment date, then I'm sure you won't be short of people who are willing to borrow from you. Let's keep shifting on. Just want to give the club a quick plug whilst we're all here, before we get to the juicy part of the presentation. If you're interested in membership, we've worked hard the last 12 months to really drive the club forward. Our first ebook went out yesterday. It's available on the Qandor website. Sean Bailey was on the front of our magazine this month. In actual fact, Nick Candy and myself and Sean will be giving a webinar in a couple of weeks' time, so that's going to be quite exciting, all around trying to make sure we've got the right mayor as Mayor of London to take us out of all this disruption that we've just been through. There's a link, should be up in the chat right now. I don't think there are even 12 slots at the beginning. I think we could only free up 11. But if you want to have a call with me to discuss how Qandor or Tropolis can help you, then click that link. Got some case studies on YouTube as well that we've been putting out. So subscribe to the YouTube channel and hit the bell icon so you get notified when we release these case studies. They're nice and short. They include the floor plans. They include the numbers, and you can learn from all of those. Right, we've done the fixed returns. We now want to get onto the profit share. So with regards to, and I'm loving the colourful cake. I could really do with some cake and a Guinness to go with it. But anyway, the most common profit share you will hear about is a straight 50-50, where the developer brings the deal and the investor brings the cash. They do happen, but there are more ways to share the spoils than a 50-50 where the developer's got no skin in the game and the investor's putting all the capital and taking all the risk. You might find that if there are two developers working together, that they negotiate a 60-40. I saw this happen recently. In fact, it was at the first Qandor meeting, two developers paired up. One of them brought the deal, one of them brought the investment, and the investors took 40%. And they negotiated the 60-40 on account of the fact that it was going to actually be 30-30-40. What you might find as well with these bigger checks is that if an investor is going to give you £2 million to fund your 12 million GDV development, that they might want more than half the equity. I'm sure Will's got something to contribute to this, but I'm just going to try and yeah, let's jump in. What are your?
Well, I tell you what, all I was going to say was you have to remember that if you do a 60-40 split, it doesn't necessarily mean that you're 60-40 on control. So the split that you do on profit doesn't necessarily need to reflect what you're doing on control of the development. And I think the other thing that I would say in here is you might have a 50-50 split, but you offer a hurdle, a soft or a hard hurdle to the investor. So you as a developer won't take anything out of the deal until they've hit a minimum return, which certainly what we do is quite a normal way of doing it.
Yeah, so the main point I want to make today is the difference between a pref and a priority return, with the pref being the hurdle, and we're going to get to it. But you're absolutely on point there, Will, because the next slide is about separating the share classes. So the developer can maintain control of the development by using one share class with all the voting rights, and the investor can have a separate share class. Another reason to separate the share classes is because some lenders might insist on a personal guarantee from anyone who's got 25% of the shares. So if you can move your investor onto a different share class, you should hopefully be able to exclude them from any personal guarantee that the bank might want. And at the same time as asking them whether they will accommodate a second charge, you probably want to be thinking about asking them if they're going to insist on a personal guarantee from anyone who's got more than 25% of the shares. And different share classes can have different rights. And you'll see in the next couple of slides how you might be able to pull that together to make your deal fit together. So Will was talking about hurdles, but before we talk about the hurdles, I want to talk about priority returns, because these are essentially, quite a lot of people confuse the two, and quite often the people confusing the two are from the office that's offering the investment, and they will try and dress up their priority return as a hurdle. And you don't want to confuse the two, and I'll show you why. A priority return is interest on their investment that comes off the table, and then the balance is split 50-50 or 60-40. So the priority return eats into the profit, whereas a pref or a hurdle It's just giving the investor that there's going to be some minimum return before you split the profits 50-50 or 60-40 or whatever it might be. So just bear in mind the difference. And if you don't understand the difference, then email yourself a reminder to watch this tomorrow and come back to the presentation and watch it a second time. The priority returns are good because they reward the investor for opportunity cost. They also incentivize the developer to be quick, but they do deplete the profit share for the developer. And if an investor is insisting on having a priority return, i.e. a rate of interest on their investment as well as profit share, then you can counter offer and say, that's absolutely fine. You can take your priority return, but I would like a development management fee, because that's going to come out of the profit and loss statement before you share the profits as well. So just be aware of some of the levers and the mechanisms you can use to level the playing field. Here's some examples of deals that might have a priority return, slightly skewed aligning, apologies for that. If their rate of interest is, it might be that there's no rate of interest / coupon. It might be that they want 5 to 8% per annum, or it might be that they want 15% per annum, but they only want 30% of the profits. Will and I know an investor who likes to work on that basis. So if the deal is nice and quick, the developer's rewarded for being efficient. But if it drags on a bit, the investor's taking 15% per annum return on their money and then 30% of the profits thereafter. The other thing about that is it's very easy to work out the fixed return and have your money back and the fixed return, whereas the variable return, you've got to mess about with the bookkeeping, work out what all the profits were and wait for that capital. But there's more than one way to skin a cat. There's no right or wrong way. But what you might find is that an investor wants 50 or 60% of the profits and no coupon, or maybe they want 5 to 8% of the coupon and 50% of the profits, or they might want a really high coupon but less of the profits. They might want the developer to put in 5% of the equity. This is actually a set of terms that an investor offers, an investor that I know, a good investor as well. And maybe they want the developer to put in up to 15% of the equity. Maybe they don't want the investor to put in anything. If there's a second charge available, someone who knows what they're doing will always want that second charge because it gives them better security. Even developers might take a second charge on their own development. So they could take the second charge personally and give themselves a better ranking in the event that the deal goes wrong and the wheels come off. They got better security in there personally, even on their own deals. And if second charge isn't available, maybe even a third charge. But then in terms of legals, it could be a shareholder agreement or a joint venture agreement that takes care of all of that. Any comments on priority returns, Will?
No, I think all I'd say is you've got to be very careful as well in your shareholder agreement, your joint venture agreement, on the definition of profit, because I some pretty wildly different and wide definitions of profit in legal agreements that I've been presented with in my time. And, you need to make sure that it is profit is what's left in the bank net of all costs. And, you can have some pretty special ones that will leave you with not a lot if you miss it as a developer.
Yeah.
I think that would be my only comment on that.
It looks like you're biting your lip. You don't want to drip anyone in it. So another one to be taken offline. Right, but this is what I think is much better. And this is what Will was referring to, is preferential returns. It's basically just, it gives the investors some surety that they're going to get their minimum return before the developer has his share or her share of the spoils. So with preferential returns, profits might be shared 50-50 or 60-40, one way or the other, but they're only shared 50-50 or 60-40, provided the investor's preferential return has been met. And if that's been cleared, then the preferential return doesn't come into the equation, and away you go. So I've got, it could be a lump sum preferential return, or it could be a return of maybe, I know one investor that will put in nearly all the money, but he wants 18% per annum because he's basically in first loss position. And provided he's got his 18% per annum, he's okay to share the profits 50-50. There was another investor. In fact, this is a great story because Tony Elliker recently installed air conditioning in my house because the club hooked him up with an investor who had £1 million. And the investor said, look, I'll do this deal with you. It looks like there's 500 grand's worth of profit in there, but I will not take less than £200,000 of profit. It was a bit harder to structure the deal because of tax and legals and things like that. But in essence, they said, let's go for this £500,000 worth of profit. We'll share it 50-50, provided my share is more than £200,000. And they did the deal, and I got free air conditioning, which hasn't been much used recently, but at some point I'm going to be grateful for it because it's an inevitable heat wave.
We structure our deals a lot with an initial percentage return, and then a catch up, and then a split. So, you know, when we were starting out, we had to offer quite a lot to our investors, and we probably offered 12 or 15% as their preferential return or hurdle. We now offer between 4 and 6, and people seem to be accepting of it because we've got a bit of track record. But yeah, we give them their return first, we catch up, and then we split the rest according to the profit split that we've agreed.
It just gives the investor the peace of mind, right? That they've got some preferential return, that you're putting your money where your mouth is, but it's also smart for the developer because he's not letting that priority return eat into the profit, which could potentially leave him with much less than before. And actually, I've run the numbers on it as well, and I'll share those. We've got a couple of questions, which I think we'll come to in a second, because one of them is just preempting a slide that's coming up. So here's some examples of preferential returns. They might want a pref of 6 to 18% per annum, and provided that's been met, maybe they'd be happy to share just 60%, just 30% of the profits, or maybe they want as much as 60% of the profits, or maybe it just be 50-50. The developer might have to put in some skin, they might have to put in nothing. The investor might want second charge, or they might be happy with a shareholder agreement or a good old-fashioned joint venture agreement. So this is to illustrate the difference between a priority return which eats into the profit versus a pref which you hopefully don't need to use because the returns have exceeded the preferential return. If you did a deal that was £2 million and the total cost was 1.6 million quid, the profit on GDV at 20% the profit is 400 grand, which the profit on GDV would be 20% because it's the profit divided by the GDV, or 25% profit on cost. Let's say, for instance, the bank have funded it to the tune of 1.2 million pounds. Some of those costs are paid out of sales, and ultimately you might need 250 grand from an investor, plus some working capital, but I'm trying to keep things simple. If the profit's 400 grand and the investment was 250 grand, that's 160% return on investment for the whole deal, not just the investor's piece, but the whole deal. A preferential return would say, right, okay, so the investor's preferential return is 10%, or maybe it's as much as 18 if in the case of the investor in Henley that I'm thinking of. But provided the investors had their 10% per annum, which they clearly have because it's up at 80%. I've made a little mistake there actually because it's a 24-month project. But anyway, the point I'm trying to make is the preferential return has been smashed. There's no need to call upon it. You can just share the profits 50-50. In the case of a priority return, the coupon is 10%, and that coupon comes out of the 400 grand profit. And what you end up with down the bottom is the investor getting a coupon of £50,000 plus half the balance of the profits, which are reduced by the coupon. And the investor ends up with 56% of the profits, and the developer ends up with 44%, which is obviously not as good as a 50-50. So just be mindful of coupons eating into profits. If someone's insisting on a priority return, try and push them down the preferential return, unless you're the investor, in which case you want to try and push them down the priority return route, because the priority return, the coupon comes off the table and the balance thereafter is split. Now, I saw a question here. It said, how does the investor protect against profit leakage, in inverted commas? I think he means, how do you protect against the developer and the contractor robbing all the profits out into the construction business and leaving the investor with nothing? And it's a very good question. And actually, the person who's asked this question is quite an experienced investor as well. I have seen this as well. And you're generally, he's just confirmed that I'm absolutely spot on. He's talking about developers nicking their profits by colluding with the contractor. And you do see this as well. I've always had a lot of trust with the investors I've worked with, and I've never had to put any cost overrun guarantees in there. But Will, I bet this is something that comes up very regularly on the deals that you do at 12 to 15 million GDV and above.
Yeah, I think it does. And I was going to say, I think how you deal with it depends on the deal size, because the monitoring or independent assessment of costs that you might need for people on a small deal, you're not going to be able to afford them. there are going to be additional costs that break the deal. But as you get to a larger deal, probably you'll have an independent QS, or you're going to have some sort of reporting structure that involves an independent QS. On our larger deals, and we have investors or multiple investors, we brought them in through an alternative investment fund. So we've had regulated oversight of what we're doing. And as part of that, we've made sure our accounts are audited independently of our own accountants. And we've had QSs reporting on costs. I think if the project size is smaller, it's very important that you have as much detail up front as you possibly can. And as a developer, you're as transparent as you can be with your cost. And as an investor, you're as demanding of what you want to see up front, and you make sure it's all laid out. And then providing you've got the right relationship going on, then you can find what you need to find.
Yeah, I think the situation that an investor wants to avoid, and the person who asked this question would definitely avoid this sort of situation, is where the investors are putting in the equity, they've got no preferential return, and the developer and the contractor are working together to siphon off all the profits into the construction business. And then if the investor's lucky, they're going to get handed back their original cash. And if they're unlucky, they're going to get handed back a lot less than this. And there was someone actually quite prolific who has been accused of allegedly doing this and ripping off all the investors, who all had to sign NDAs. And that's why none of the investors are complaining about it, because they've all been gagged in the legals on the way into this deal. But the cash goes in, all the construction costs overrun. Suddenly the deal's not making any profit because it's all gone to the builder, and the builder's off on a jolly. So you do want to protect against that. You want to be thinking as an investor, which was the person who asked this question, you want to make sure you're protecting yourself against cost overruns, maybe putting a preferential return in there to make sure that you're not just wasting your time helping the contractor collude with the developer and get rich off your money. In terms of legals, joint venture agreement, shareholder agreement, the borrower or the deal pays for the legals. Because if there's a big issue, why would the lender want to be left with a 1,200 quid bill checking the legals that were flawed or substandard? Little tip on heads of terms here. When you are working with a developer or you're working with an investor to agree terms, generally what is considered best practice is to have the coffee, have the lunch, build the rapport, but at the right time, and it doesn't have to be like after weeks, you can get to this point quite quickly. Say, like, look, I want to come around and sit down and discuss the heads of terms. What would this look like? And if you do it in person, you shouldn't sit opposite them. You should sit next to them, and you write them together, and you get the details into the heads of terms, and you either sign them there and then, or you send them to be signed, and you use the next step, which is we get the solicitors involved and make it all official. But the heads of terms is a really good way just to get everything down on paper and agree who's doing what, what's included, what's excluded, what the terms are, and that's a great way to move things forward. It shouldn't be a long document. You should be able to get it onto 1 or 1.5 pages of A4, and then the next step would be solicitors. How long do you normally take to get an investor to sign your heads of terms, Will? First date?
5 minutes to 5 years probably is my range.
How long's a piece of string?
Yeah. Again, it depends on deal size and what it is, doesn't it? But the best partnerships take a while, and I think the best partnerships, you start talking to somebody when you haven't got something you want them to invest in.
Yeah, start warming them up early.
And you have conversations about what you do and how you do and what your philosophy is before you start hitting them with, please have some money.
Yeah, to see if your values are aligned and your expectations. I'm just mindful of the time. I'm going to have to pick up the pace a little bit because it's actually in 1 or 2 slides. This is a good trick because it ties everything together now. Before that, though, I just want to mention sweat equity. This is quite a good way of aligning the interests of the consultants that you work with. You can agree to pay the consultants a premium on their fee proposal. I wouldn't mention sweat equity before you get a fee proposal from a consultant, because you might find that they price up knowing that they're going to be putting some of their fee at risk. But you would invite someone to give you a fee proposal, and then you'd ask them to defer payment of some of that fee upon success of the plan and permission that you're going for, And it might be as much as 50% of the fee I've seen with some planning consultants, or it might be less than that. But you want them to have some skin in the game. Let me give you an example. If you find a deal and you approach the architect and say, I really want to do this deal. Can you give me some advice? Is this going to be a good deal? If you say yes, I'm going to give you £50,000. And if you say no, I'm going to give you nothing. What do you think he's going to say, or she? They're going to tell you it's a good deal and you should definitely do it and you should take lots of risk. And whether it comes off or not, there's going to be no skin off their nose. They're going to get their 50 grand of fees and you might be left licking your wounds. So you do want your consultants to have some skin in the game, and you'd like them to have some of their fee at risk so that you can not just lose together, but win together as well. So bear in mind the sweat equity. Raising sweat equity from your consultants as well also means that you need to raise less from your investor. And if you need to raise less from your investor and you've got an incentivized team, you've probably got a better chance of getting an investor on board in the first place. And this is where you can use something called the cap and collar, which I actually first found out about. It was a bit of a long story, but it was over 10 years ago. And I started looking at how I can apply this to property deals. So the collar is like a pref. It's the minimum return that the investor is going to get before the profits are shared 50-50 or whatever it might be. And the cap is a maximum return. So if your investor, if you find that you're in a conversation with an investor and you're trying to agree heads of terms, and they say, well, I want a priority return, you manage to wean them off the priority return and get them onto a preferential return. Say, look, I'm happy to give you a nice high preferential return, but I'm also going to use a cap. So you can have your collar, but I want the cap as well. So have your minimum return of 18% per annum, but I'm going to cap you out at 30% because I want to shoot for the stars and I want to perform. And if I do perform, then I'm going to tap you out at 30% per annum. So let me give you an example here. Say, for instance, the investment is £100,000 and the security is shares in the SPV, and you've got a shareholders agreement or a joint venture agreement, whichever it may be. The cap might be a return of 25% per annum, and the collar might be a return of 15% per annum. And you would link the performance of their investment to a certain number of shares in the SPV, and in this case, it might be 25% of the profits. And I've got a case study coming up. So you say, right, your exposure or your investment is aligned to 25% of the SPV. Your return cannot be less than 15% per annum, but it cannot be more than 25% per annum. And that's a smart way of it's a smart way of bringing your investor into the deal and giving them some peace of mind that they've got a minimum return, but it's a smart way of also not giving away all your profits. And if it was for like a slam dunk planning gain deal, then it would work really nicely. So I've been exploring this recently with one of the guys on the Tropolis program. His name is David Williams from Joint Ventures in Land. He signed a 5-year option on a piece of land in Essex, and it looks like it's outside the boundary, but it's actually not, because the adjacent sites are going through planning, and the site to the northwest has just been given outline plan consent for 100 houses. And if the planning comes through and you get 20 units on there, the value of that land's going to go through the roof, and you don't necessarily need to give someone 50% of the profits in the SPV to bring them on board. Say, for instance, the value of the land is 2.4 million quid with planning. The original investment was £100,000 to get it through planning. If the purchase price is 1.3, and I'm probably excluding some transaction costs just to keep the example simple, you could be looking at £1 million profit. That's 1,000% return on investment. You just want to be saying to the investor, look, I'm happy to give you a handsome return of not less than 15%, but not more than 25%. And the investor's going to end up with a return of 125% if it's a 5-year investment. And 125% return is pretty bloody good return by anyone's standards. I think I'm coming just towards the end. This is the last slide. Will, was there anything you wanted to contribute before we open up to the Q&A?
No, I need to say that a cap doesn't have to be sort of a hard limit, does it? So you could be 50-50, but above a certain return, you're 75-25 in the developer's favor, gain to 90-10 if you get a super profit or something, so that you keep your investor's interest and his peak. He doesn't mind when you're trying to push sales prices at the end, because it still has some benefit to him. You haven't turned him off, but you get the reward for calling it right if it happens. Yeah,
I think that's a very good point, actually. It doesn't have to be a hard lock. You can just increase the profit share in favor of the developer. There's a neighbor of mine, actually, who runs a multi-family office, who's funded a lot of very well-known developers. And that's what they do. They're happy if they're getting sort of 20-25% annual return. And if the developer knocks it out of the park, then he's going to be very handsomely rewarded, and it incentivizes the developer to go out there and really, really perform. And it's equitable. It also means that the investor who wants to push money out the door is competitive in the marketplace as well. In actual fact, that neighbor, if people didn't go to Christian Candy for the equity, they went to this guy, and they were fairly close on terms, I think. So a couple of final tips for you. Use the heads of terms to get terms agreed. That's your quickest route to getting the investor on board, because they're not going to sign heads of terms. They're definitely not going to sign any joint venture agreements. Exercise caution with PGs if you're an investor. You don't know how many PGs the developers put out there. They might have put out quite a large number of PGs, and it might mean that your PG is about as useful as a chocolate radiator.
Also, basically impossible to enforce, right?
You can't take the house off them.
You can't take the house because the wife will cry foul, even if she signed it. You've got to be, you're going through a very, very long journey to try and get your money back. And I don't think anybody should be lending on the basis of a PG. They should be lending on the basis of a strong commercial proposition where a PG, if you get it, ties the developer in and just make sure that if it's going wrong, he doesn't paste you the keys and go, sorry, mate, here you are.
It's not worked out.
It's not worked out. Over to you.
Yeah. I was asked to review a PG a couple of weeks ago, and it was just an attachment to an email, and the investor was supposed to accept it as a proper PG. But I don't know about you, Will, but when I sign a PG and the bank insisted on a PG, I have to go to my solicitor's office, declare that I've had the proper advice, sign it in front of him. He witnesses the signature, and the bank gets a proper PG. But if you meet someone on Instagram and they email you their PG and say, there you go, there's my PG, you need to understand PGs a little bit more than that, if that's what you're relying on as your security. Another tip in here for you is, I actually did this in 2017. Some friends of mine needed a loan pretty quickly. There was a bit of a hiccup on their deal. They just needed a bit of a top up. It was a short-term loan. I didn't have time to do any due diligence on them or their assets and liabilities, but they're three really nice guys with good reputations, and they were going to lose their deposit. I said, look, you all sign a loan agreement. I'll send you the money tomorrow, but you're joint and severally liable, which means that if I don't get my money back, I can go after any one of you for the whole amount. And that was enough to give me comfort that I stood a good chance to get my money back, and they didn't lose their deposit. They were waiting on some SAS money to come out from the pensions, and it just hadn't arrived. And then there's another one on here which is about preemption rights and dragon tag, but probably a bit too technical. I think we should open up for some questions, but I just want to mention dates for your diaries before we go to the questions. I can see we've got lots of questions coming through. The next webinar is on the 4th of March. Write that down, put it in your diary. It's the day after the budget. Qandor member Heather Cunningham is going to be giving us an update on the budget and how we've all been affected by whatever Rishi Sunak has got in store for us. I'm betting that corporation tax is not going to be 19% come March the 4th. And there might be one or two other bombshells in there as well. So if you want to know what's come out of the budget and understand it, Heather and I are going to have a brainstorming session and bring it all together on a webinar on the 4th of March. This next slide I'm particularly excited about. Nick Candy doesn't do a lot of this sort of stuff, but he is, to be confirmed, going to be on our webinar on the 10th of March. And the reason for that is because Nick and I are working with Sean Bailey to help him raise his profile and get out there and win more votes on May the 6th. You should have had your form from the council if you live inside the M25 to make sure you can vote on May the 6th. At the moment, Sadiq Khan is trying to delay the lockdown. By coincidence, the longer he delays the lockdown, the less leaflets Sean Bailey can push out. But Sean's a really nice guy. He comes from a very humble background. He's a very surprising Tory candidate to be the next mayor of London. And you can join Nick, Sean, and Greg and myself on March the 10th for another webinar. Last plug for the club. I have no idea how many slots are available. I've been too engrossed in conversation with Will. I want to move on to the Q&A, but if you are interested in via Qandor or Tropolis, I've done all of the discovery calls for Tropolis so far. So if you book your call via the website, I promise you it will be with me. And if you want to do that and you haven't done it yet, then you better do it quickly because there might not be any more slots left. Will, have we got any questions from the delegates?
Hi, I hope you're enjoying the free content. My name is Matt Siddell. I started Qandor in 2017. In 2020, we launched a property academy called Tropolis. If you want to know how you can come and join our fantastic network and work with the wonderful people that we help and support, then click the link below and book your call with me today.
We've got an anonymous attendee who wants to know, if the developer has very little experience in property development, what can they do to provide security for the investor?
Well, security could be first charge, second charge, or an RX1, or it could be. I know we just slagged them off, but it could be a personal guarantee. If it's between friends and family, that might be enough to give them the trust that they need.
Or it could be for your first couple of deals, finding a partner or someone to work with you who has got that experience, couldn't it?
Yeah.
So, and it might be somebody that you give a little bit of equity to, who stands beside you and supports you with a bit of advice, legitimacy, decency in getting your deal going, maybe comes to your first meetings with the bank with you when you're trying to raise debt and helps you build track record. I would have thought, and without wanting to plug Qandor or Tropolis, the people that you meet inside the club are the sort of people who would be interested in helping you do that, who have that sort of experience and will share what they know and can help you present yourself to investors so that you don't look like a very young lone wolf.
The thing about giving someone experienced a stake in your deal is also that they're not going to get involved if it's a waste of their time, and they can help you not waste your time on deals that are either marginal or not worth the risk, and help you save time on duds. I remember when I first got really serious about property, I'd already done some buy-to-lets and everything, and people were really keen on doing joint ventures with me and my JV partner at the time. And if I'd known how much I could have learned and how quickly I could have learned it, I probably would have done those joint ventures, but I just didn't understand what I was doing. And no, even just listening to this presentation in 2011 probably would have put me on a better trajectory, because I didn't have a clue what any of this stuff was. First charge, second charge, mezz, it was all Greek to me. But yeah, giving someone experienced a stake in the deal is a good idea. Doing a small deal cash makes sense. A lot of people want to be developers and they think, right, I need a limited company and off I go. But I know really experienced people who've got very large portfolios, and they say doing your principal residence is the best deal you can do. The stamp duty is less, the funding's cheaper because you just get a big fat mortgage at 2% instead of going to a lender and paying 9%. And then if it is your principal residence and you do one, maybe do a couple over whatever time frame, there's no tax. So I would say the first deal you should do should be your principal residence. It's a bit hard if you're married with kids and stuff, because logistically it gets a bit tougher. But these are some of the things we talk about on Tropolis. We've got a skipper on a boat down in Mallorca. He's actually the skipper for someone who's a really big deal in property. But he wants to do his principal residence and he wants to get it right. And he's off to go and form a limited company and pay loads more for his finance. I was like, don't do that. Just like principal residence, big fat mortgage, and RX1 from a friend or family is probably going to see you there. Any other questions, Will? I went off on a bit of a rant there, sorry.
Yeah, Demir Romanoto wants to know, would it make sense to use your own funds if you were liquid rather than using private investors or lenders?
Yes. No, I'll extrapolate on that.
I'm not sure I always agree.
We had this in Reading. Like, we had cash and we're like, right, we need a bank. And then my JV partner was busy in the city being a captain of industry. And I said, look, we've got the cash. Let's just use all our own cash. And when we run out of it, then we'll go to the bank. And we ran out of it. And I said, have you got any more cash? He said, yeah, I'll put another £1 million or £2 million in. And he actually bridged to our joint venture vehicle at 2% per annum, because there was some other stuff involved. I was like, look, bridge in here. He said, I'm not doing it for free. I was like, all right, do it at cost, 2%. And he bridged into the joint venture vehicle at 2%. But it just meant that whenever we ran out of cash, there was another 300 grand dropped in the bank account. It's just not like that when you work with private lenders. If you do need to work with private lenders, though, you want to work with ones who are quick and efficient. You're never going to get fast money out of a high street bank. Isn't that right, Will?
You're never getting fast money out of a high street bank. Look, I think what I'd say that is you're very fortunate enough to have a lot of cash. There's no better way to buy and acquire than be the guy who walks in and slaps the money on the table. But, cost of lending's low and cost of borrowing's low. So if you can gear it up a bit later, then you can do it, you can move on, you can make your return on equity better.
Yeah.
But it's all about profile as well, isn't it? It's what you feel comfortable with. And if you think something's more speculative, or I think something's more speculative, I'm probably happier having more cash in it because I have a buffer, I have more flexibility, I can work my way through it. If I feel something's pretty much nailed on its way to exit, then I might be happy to gear it up a little bit more so I've got liquidity to go and do something else. So I think it's about managing your portfolio with the resources that you've got.
There's different, everybody's situation is unique to them, right? Will, you've got 140 acres in Cornwall and you want to do a boutique hotel that's going to be 60 keys, plus the Muse in prime central London that you're doing. And you still own a couple of those units in Wimbledon as well. Your cash, you're always going to find a good use for it. And you're always going to want the cheapest debt in there that you can possibly get, which is going to be the senior debt, versus other people who, maybe they're just, there's one person in Tropolis, without naming any names, and they don't want any debt, and they've got all this unencumbered property. And I've done the spreadsheet for them to show that if they just put a gentle bit of debt in there, they in 2 refinances, they can go from an 800 grand portfolio to a 4 or 5 million pound portfolio. So you do want debt, but you do want the right debt, but you don't want more admin either, because no one likes admin. God, the questions are coming through thick and fast, aren't they? Let's see how many we can get through. We've still got nearly 100 people on the call. Got a good one there.
Rogerson, what with the hurdle is the
Isn't
hurdle?
he a famous architect?
That's Richard Rogers.
Oh.
No. Is the trigger point for splitting profit between investors and developers, or does the investor get their hurdle return first before remaining profits are split? Depends how you organize it. We always offer a hurdle to our investors. So until they've reached the hurdle, we won't take anything out of the deal. Then there's a catch up to the same, and then there's a split. We always invest alongside our investors because we think we have to, but we buy the same class as they do to make our investment. So we have the value into a deal comes through the investor class of shares, and the control in the deal is through the developer class of shares. We normally own all of the developer class of shares, and where we put our money in, we buy investor shares alongside our investors. And the way we set it up means we can have one investor or many investors. The investors have a minimum return before we take anything for the benefit of doing the deal, and then we split it after that.
I think, Richard, your question at the end, the second part specifically says, does the investor get their hurdle return first before the remaining profits are split? That wouldn't be a hurdle. That would be a priority return. That would be interest on their investment. If they're getting that return first and then the profits are split, they're charging interest on their investment, and that's not the same as a hurdle. A hurdle just means provided you're above a certain watermark, we'll split the profits 50-50, 60-40, whatever. And if you want, just go back over this presentation when it's on the website tomorrow and watch it a second time, and you'll get it. We've got another question here. Sam Archie, is it fair to split the profit 50-50 after the cost with an investor who just puts the money and has no knowledge or experience? Is it fair? I'm not quite sure what he means. In my experience, no investor is going to do a deal until they're comfortable with it. That amygdala is going to be kicking in their flight or fight response and saving them from losing money. So yeah, that's what it's all about, getting comfortable with the deal. Will, can you pick off a couple more questions here?
Yeah, Simon Meikle has come back. If he's happy with no issue with the developer shooting the lights out, he's more downside focused. I guess that probably follows on from a couple of things you asked earlier, Simon. I would have thought as an investor, your principal thought should be downside mitigation. What's the worst case scenario? How do I walk out of this with my cash? And when a developer is presenting to you, You know, I don't know. When I'm presenting to investors, I think the first thing I tell them is how I'm looking after their capital and what we're doing. And after that, it's a number of steps on, you know, in the base case, this is what we expect your return should be. In the worst case, this is how we're protecting it. And these are the value adds that we believe we can get during the deal. So, yeah, I don't know. I'd hope any developer is providing that sort of answer. Matthew Soltis has asked, is there any thoughts, Matt, on the approach to raising long-term corporate bank debt at a holding company level to forward fund your property acquisition and development company? Currently assessing this opportunity and revising business plan to capitalise my main property holdco and lower funding rate across my development business for the next 3 to 5 years.
That's a pretty sophisticated question. Why don't you answer it, Will? You're talking about restructuring his portfolio there, and there are family offices that would love to look at that.
Have you got any asset in your holding company that the corporate or the bank is lending against? Because I think if you haven't, and it's speculative, then you're probably going to find it's quite difficult. What you might be able to do, depending on the company structure, is get a revolver or some sort of agreed credit facility. So providing you're hitting certain parameters, you know that if you get a valuation, you'll be able to draw down against stuff. You know, we certainly now as a business, we're looking at more formal equity lines so that we know, providing we hit a certain set of criteria, we've got access to equity and what the outline framework of that equity would be. You know, I think what you get from having those sort of arrangements is certainty, which allows you to go into deals where you're purchasing with more confidence. I don't think it necessarily gets you the best price in the market, because if you're getting people holding that money available for you so you can do what you want, you're going to have non-use, cost of allocation, and that sort of stuff. So, you know, it's a market where the pricing on what you can get changes all the time as well, and you're probably better off getting debt as and when you need it at the best price in the market.
Yeah, the sorts of deals that you do, Will, I imagine that you don't actually build any affordable housing, or you certainly wouldn't do 100% affordable housing scheme, which is fully forward funded. Your affordable housing contribution is probably always an off-site contribution, isn't it?
Yeah, we've had a couple of developments where we've built affordable, but to be honest, we try and just stay under the radar, so that the worst case scenario is we make a contribution.
All right, I'm going to take one last question and then call it a day. I've got a question here from Sunny Palmer. Would you encourage the approach to development where the developer is also the main contractor? It just jumped on me. And would investors find this structure preferable to a third-party contractor doing the build? So I think what Sunny's asking is, like, is it a good thing when the developer is the main contractor? And is that better than having an external contractor? Well, it touches on what we were talking about a few slides back, where there is potential for the developer, if they are also the contractor, to drag profits out of the deal and into the construction business because of some variations that have happened in the scope of works or what have you. Like, oh, I'm really sorry, we got the mechanical engineering scope wrong and it's an extra £200,000, or we need to put this staircase in and it's 50 grand, or some other bullshit way of extracting profits and taking the profits away from the investors who want to get the profits out of the deal and pushing those profits down into the construction business. I saw someone once who had a 50-50 construction business with a contractor, and it was clearly just there to collect the profits from the deal, because the developer, you know, had no reason to have their own construction business. It was really just a vehicle for pulling profits away from investors. Pretty unethical stuff, really, and we wouldn't put up with any of that shit in Qandor.
We tend to tender everything, you know, we're developers, not contractors, and it's a different skill set. And so we try and find the right contractor for the right deal, and different projects require different skills to get them done. So, yeah, I think going back to Simon's question, I think it was earlier, about making sure things aren't being squirreled away by the developer and the contractor. I think if they come to you and they're all in bed together, then there's a lot of room for hiding stuff, and the investor could lose out.
I think there's a few other questions there, but there's no way we can get through them all. I think we've probably picked off about as much as we can help with. It's down to me just to thank Will for joining us today. You've been a great wingman, definitely needed some support. You made a great contribution as well, a natural. Maybe we'll see you hosting some webinars before long. And I just want to say thank you to everybody who joined us. Really strong turnout today. Make sure you connect on LinkedIn and make sure you hook up as you leave and book your strategy call if you're interested in finding out more about Qandor and Tropolis and how we might be able to work together. I've been Matt Siddell. Will's been Will Herrmann. Thank you very much for joining us.
Thanks very much. Cheers, guys.
So if you enjoyed this video, why not check out some of our other videos? I recently interviewed lots of fantastic people. There's loads of good content in there. Thanks for watching. I hope you enjoyed it. I'll see you in the next video.